Imagine a product that costs 1,400% more than it did 40 years ago. Not a luxury item, not a rare commodity. A product that society tells every young person they absolutely need, that employers increasingly require as a baseline credential, and that the government will happily lend you the money to buy. No credit check, no income verification, no cosigner required. At 18 years old, before you've ever filed a tax return, rented an apartment, or had a single conversation about compound interest. Now imagine that the institutions selling this product have zero financial stake in whether you can actually afford it, zero liability if you can't repay what you borrowed, and a business model that gets more profitable the more the price goes up. Because higher prices mean more loan volume, and more loan volume means more tuition revenue, and none of the risk ever lands on them. That product is a college degree, and the system built around it is one of the most elegant, legally protected, financially catastrophic wealth transfers in modern American history. Here's the thing: college was not always like this. In 1980, the average annual cost of a 4-year public university, tuition, fees, room and board, was roughly $3,500. Adjusted for general inflation, that's about $13,000 in today's dollars. The actual average cost today? Just over $28,000 per year at a public university. Over $58,000 at a private one. General inflation since 1980 is up around 300%. College tuition is up over 1,400%. Those two numbers should not exist in the same economy. And yet here we are. The question worth asking is not whether college costs too much. Everyone agrees it does. The question is why. And the answer is not greedy administrators. Though some of those exist, it's not lazy professors. Though tenure is a whole other video. The answer is structural. It's a feedback loop. And once you see it, you cannot unsee it. In 1965, the federal government created the Student Loan Program to help lower-income students access higher education. The intent was genuinely good. Education creates economic mobility. Removing financial barriers makes sense. But here is the mechanism that nobody fully anticipated. When the government agrees to lend unlimited money to any student admitted to an accredited institution, regardless of the student's ability to repay, regardless of the earning potential of their chosen field, and regardless of whether the institution actually produces the outcomes it's selling, the institution has no incentive to keep prices low. None. Zero. Think about it from the university's perspective. If your customer can always get a loan, if the demand for your product is backstopped by federal credit, you can raise your price, and the demand barely moves. Because the loan absorbs the price increase, the student doesn't feel the $5,000 tuition hike as $5,000 out of their bank account today. They feel it as a slightly larger number on a loan document they sign at 18 and don't think about again until they graduate. And that psychological distance between the price and the pain is the entire engine of the system. This is called the Bennett Hypothesis, named after a 1987 op-ed by then Secretary of Education William Bennett, who argued that increases in federal student aid directly enable universities to raise tuition by a corresponding amount. Multiple Federal Reserve studies since then have found evidence supporting the basic mechanism, that for every dollar increase in subsidized loan availability, Institutions capture a significant portion of it through price increases. The university isn't gouging you. It's just rationally responding to the incentive structure it operates inside, which somehow makes it worse. Now let's talk about the person inside this system. Meet Jordan. Jordan is 17, has decent grades, and wants to study communications. Jordan's parents make $75,000 a year combined. Solidly middle class, too much income for meaningful need-based aid, not enough to write a check for $40,000 a year. Jordan applies to schools, gets into a private university with a nice campus and a well-marketed communications program, and is offered a financial aid package. The package includes $6,000 in grants, $5,500 in federal subsidized loans, and a $10,000 Parent Plus loan. The guidance counselor calls it a generous package. The gap is $20,000. The family is told they can take out additional private loans to cover it. Jordan signs. Jordan's parents sign. The university collects. This happens roughly 2 million times a year across American higher education. And at the moment of signing, almost nobody in the room has done the math on what monthly payments will look like against a communication salary in a mid-sized city 4 years later. Here's that math. The average student loan borrower graduates with about $37,000 in debt. At a standard 10-year repayment on federal loans at current interest rates around 6.5%, that's roughly $420 per month for a decade. The median starting salary for a communications graduate is approximately $40,000 to $45,000 annually. After taxes, that's around $3,000 per month take home. $420 of that, about 14% of take-home pay, goes to a loan payment before rent, groceries, transportation, or health insurance for a decade. And that's the median. Half of borrowers owe more than $37,000, and the fields with the most enrollment, education, social work, liberal arts, communications, are also the fields with the largest gap between loan burden and entry-level salary. Now here's the part that makes student debt uniquely brutal compared to every other form of debt in America. You cannot discharge student loans in bankruptcy. Not federal loans. Not most private loans. The legislation that made this true was passed in 2005, lobbied for aggressively by the financial institutions that held private student loan portfolios, and signed into law with almost no public debate. Every other debt in America, credit card debt, medical debt, business debt, gambling debt, can theoretically be wiped clean through bankruptcy. Student loans cannot. Meaning, if you borrow to go to a university that closes 2 years into your program, if you borrow for a degree that the job market rendered worthless, if you borrow at 18 and make decisions that 35-year-old you would never make, the debt follows you. It accrues interest during deferment. It can garnish your wages. It can take your tax refund. It can follow you into retirement and offset your Social Security payments. The historical parallel here is not subtle at all. In medieval Europe, debtors who couldn't repay were sometimes imprisoned or indentured until the debt was worked off. Society eventually decided this was barbaric. The concept of bankruptcy was created precisely to give individuals a path out of debt that had become unpayable, to acknowledge that circumstances change, that people make mistakes, and that permanent financial servitude benefits nobody. America extended that grace to corporations, to gamblers, to failed business owners. But it specifically and deliberately did not extend it to 18-year-olds who borrowed money to go to school. And nobody who voted for that law had a student loan. Let's talk about the universities themselves for a moment, because they are not neutral actors in this story. The top 100 universities in America collectively hold endowments exceeding $400 billion. Harvard's endowment alone sits at over $50 billion, an investment portfolio larger than the GDP of most countries. These institutions pay no federal income tax on their investment returns. They receive federal research grants. They benefit from federal student loan programs that fund their tuition revenue. And in many cases, they continue raising tuition at 3 to 5% per year, while sitting on endowments large enough to make every student's education free for the foreseeable future. Harvard could theoretically eliminate tuition tomorrow and fund it from endowment returns for decades without touching the principal. It has chosen not to. Because tuition revenue isn't just money, it's a signal. It's what funds the amenities that drive the rankings, that attract the students, that justify the tuition that grows the endowment. It's a feedback loop that is beautiful for the institution, right up until an entire generation of graduates can't afford to buy homes, because 14% of their income is servicing the cost of entry. So what can you actually do if you're 17, 18, or the parent of someone who is? Run the numbers before you choose. Divide expected total debt by 10 and see if the monthly payment is serviceable on the median salary of your intended field. If it isn't, the school is too expensive for that major. Treat community college as a financial strategy, not a consolation prize. 2 years at a community college followed by transfer to a 4-year institution can cut total debt by 40 to 60% for a degree that reads identically on a resume. Understand that the sticker price and the net price are different things. Use the net price calculator every school is required to publish. The sticker price is marketing. The net price is what you'll actually pay. Federal loans first, always. Federal loans have income-driven repayment options, forgiveness programs, and deferment protections that private loans do not. Private student loans are closer to credit card debt in terms of your exposure. If a school's financial aid package includes a Parent Plus loan as a core component, that is the school telling you it costs more than your family can afford. That is not a financial aid package. That is a payment plan dressed as generosity. And here's the uncomfortable truth. The student loan crisis is not an accident. It is the predictable, documented outcome of a system where one party, the university, collects money up front with no risk. A second party, the federal government, underwrites unlimited credit with no underwriting standards. And a third party, the 18-year-old, bears 100% of the risk for a decision they are uniquely unqualified to make at the moment they're required to make it. Nobody in this structure has an incentive to make college cheaper. The universities need the revenue. The government needs the political narrative of college access. The private loan industry needs the volume. The only person who needs it to be cheaper is the one person with no seat at the table, and somewhere right now, a 17-year-old is opening a financial aid award letter and being told this is an opportunity. So drop your take in the comments. Do you think the student loan system is A, fixable with better financial literacy education and smarter borrowing decisions at the individual level. B, a structural problem that requires federal policy intervention to cap tuition or reform bankruptcy law. Or C, a three-way collusion between universities, the government, and lenders that will never reform because every institution in the chain profits from the current arrangement, because the most expensive education in America isn't the one with the highest tuition. It's the one where nobody told you to do the math first.